Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, August 22nd, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is another lot of red on the screen here, at least domestically. I see a little more green across Europe and also in the Asia markets overnight. So it looks like the laggard here is the U.S. markets, unfortunately. So it is what it is. Again, hope everyone's having a good day out there. It is warm here in Colorado. It is, what's the temperature right now? Well, that's the temperature. It is a balmy 85 degrees here. So, granted, if you're down in Houston, you probably don't get a lot of sympathy from me or for me. My wife was down in Houston the last couple of days for business, and she said it was quite warm. Although she did stop by Academy and get me some new Astro shirts, which was very nice of her. So, all right. Well, you didn't come here to listen to travel advice or the heat here in Colorado, but I am glad you're here. Thank you very much. If you could, give me some thumbs up, like, share, subscribe, follows, press that notification bell so that you know when I go live. And let's go ahead and get into the numbers for today. All right. Dow Jones was down 0.51%, 174 points, closed at 34,288. S&P 500 was down 0.26, closed at 4388. NASDAQ flat at up 0.06, closed at 13,505. The VIX was down 0.93%. It was in the green most of the day. Finished off at 1697. Canada was down 0.47. Brazil was up 1.54, and Mexico flat at up 0.03. Our friends over in Europe, Germany was up 0.2%, the UK up 0.18%, France up 0.59%, Netherlands up 0.63%, Spain up 0.55%, Italy up 0.64%, Switzerland up 0.25%, and Portugal up 0.23%. Russian exchanges both in the green today, the MOEX up 0.77%, and the RTSI fairly flat at up 0.05%. And the overnights, the Nikkei in Japan was up 1.05%, Australia flat at up 0.09%, New Zealand up 0.69%. In China, the Shanghai was up 0.88%, Shenzhen Component up 0.53%, China 50 up 0.68%, DJ Shanghai up 0.77%, Hang Seng up 0.92%, and it looks like the Taiwan weighted was not open again today. All righty. So like I said, here domestically, if you're watching the charts all day, you probably thought the whole day was a wash, but mostly just the markets here domestically. All righty. Well, let's get to the market recap. Dow, S&P 500 ease as rate worries mount. Banks shares dip. All right. On Tuesday, U.S. stocks showed mostly minor declines amid persistent concerns about prolonged higher interest rates by the Federal Reserve, causing unease for investors. Financials experienced the most significant dip, down 0.8%, which had a notable impact on the S&P 500. The downgrade of multiple regional U.S. lenders by S&P had a particular impact on bank shares, with KBW Regional Banking Index dropping by 2.4%, and the S&P 500 Banks Index by 2.1%. The anticipation of greater insight into the rate outlook, as Fed Chair Jerome Powell is scheduled to speak at a Jackson Hole meeting on Friday, is a significant driver of the market sentiment. The recent increase in the benchmark 10-year Treasury yield, reaching almost 16-year highs, has led speculation that the Federal Reserve might prolong the period of elevated interest rates. Really? Who has said something like that? Me. I just going on out there. All right. The tech sector was also in focus, with investor attention directed towards chip company NVIDIA's upcoming results and forecasts due to be released on Wednesday. Following NVIDIA's robust report last quarter, which fueled a surge in tech stocks and optimism surrounding artificial intelligence, the stock reached an all-time high of $481.87 before dipping 2.8%. In terms of individual stocks, Macy's experienced a significant drop of 14% after the department store chain issued a warning about weak consumer spending anticipated during the crucial holiday shopping season. The New York Stock Exchange saw more declining issues than advancing ones, with a ratio of 1.34 to 1, while NASDAQ, the ratio was 1.38 to 1 in favor of decliners. In terms of new highs and lows, the S&P 500 recorded 4 new 52-week highs and 12 new lows, while the NASDAQ Composite noted 37 new highs and 196, easy for me to say, new lows. All right. Good stuff we got going out there, folks. All right, next up on the docket, U.S. existing home sales slide again, but prices up from a year earlier. Yeah, so sales are slowing, but prices aren't really falling yet. U.S. existing home sales reached a 6-month low in July due to a reluctance of homeowners with inexpensive mortgages to sell, given the steep costs of new mortgages, which have surged to not historic. My father and mother purchased a house in 1978 in the Clear Lake area of Houston, and I think their interest rate was 12%. And that was pretty good, seeing that the rates were, in the high teens at the time. So anyways, the limited inventory, however, led to a year-over-year increase in prices, marking the first such since January. In July, existing home sales dropped by 2.2% to an adjusted annual rate of 4.07 million units, the lowest since January, as reported by the National Association of Realtors. Although sales rose in the West, where home prices had fallen notably in the previous year, the Northeast, Midwest, and South experienced declines. Home resales, a substantial component of U.S. housing sales, fell by 16.6% year-on-year in July. The supply shortage of existing homes has spurred growth in new home construction and sales, but this inventory constraint, coupled with surging mortgage rates, has created challenges for potential buyers. With mortgage rates recently surpassing historic levels, there were 1.11 million previously owned homes on the market last month, a 14.6% decrease from July of 22. The median existing house price climbed 1.9% year-on-year to $406,700 in July. The scarcity of available properties has influenced new home construction and sales, with the National Association of Realtors predicting a 12.9% drop in total resales for 23 compared to 22, while total new home sales in 23 are projected to rise by 12.3%. Properties generally remained on the market for 20 days in July, up from 14 days the previous year. First-time buyers constituted 30% of sales, a slight increase from 29% in the previous year. Homes priced above $1 million experienced the least decline in sales, as their supply was relatively constrained compared to lower value homes. Matthew Walsh, an economist at Moody's, noted that predicting mortgage rate trends in the near future is challenging, but it is expected that rates normalize in the coming year. However, the current rates might continue to compete with mortgage rates secured by the majority of existing homeowners before interest rates escalated, which could sustain the lock-in effect for a significant period. So it's kind of a good news, bad news situation right now. Got a frog in my throat. All right. Next up on the docket comes from Zero Hedge. It's titled S&P joins downgrade party of U.S. banks due to tough, and that's in quotes, climate. All right, let me get my notes. S&P Global Ratings has downgraded several regional banks, predicting a challenging outlook due to higher interest rates and deposited outflows. 5 banks, including Key Corp, Comerica Inc., Valley National Bank Corp., UMB Financial Corp., and Associated Bank Corp., were downgraded by 1 notch, with negative outlooks for River City Bank and S&T Bank. Zions Bank Corp. Remains under negative review. The downgrade stemmed from a, quote, tough lending environment, and depositors move funds into higher interest accounts, increasing banks' funding costs. The decline in deposits has led to liquidity constraints, coupled with the decrease in value of bank securities, which can constitute a significant portion of their liquidity. S&P's downgrades follow Moody's recent rating cuts for 10 small and mid-sized banks, driven by higher funding costs, potential regulatory capital vulnerabilities, and risks associated with commercial real estate loans. Moody's analysts anticipate further challenges, including a mild recession in early 2024. Mild? Okay. Resulting in tightened credit conditions and increased loan losses for U.S. banks. Fitch Ratings also hinted at possible rating downgrades for numerous banks, including major ones like JP Morgan. The KBW Bank Index, reflecting major U.S. banks, remains at levels comparable to when several regional banks faced difficulties earlier this year. This banking turmoil coincides with the Federal Reserve interest rate hikes, which have reached the highest point in 22 years. Swap contracts referencing future Fed policy meetings suggest that the target rate could plateau at 550 basis points, which is 5.5% for normal people, signifying the potential terminal rate. The full impact of this tightening cycle is yet to be realized, and S&P warns that higher rates are pressuring borrowers, particularly those with significant exposure to commercial real estate, particularly office loans. Some commercial real estate markets are already experiencing distress. Not good news. I mean, really the last, 3 years have been pretty terrible for the commercial real estate market. I know I've been steering clear of it for my clients during that time just because, after the whole pandemic thing and everyone was working from home, most retail and office spaces were, sitting empty. And so, until that market, collapses and bottoms out, I really just don't see it being granted, there's going to be spots here and there. If you're looking at individual properties, you might find some good diamonds in the rough. But, as a whole, I would just, stay away from it for right now, at least until, I'd at least wait until the business person decides that they want to actually work in offices again, if they ever do. So I personally don't. I like working from home. It's it's really nice. All right. Last up comes from Mises Wire. It's titled "The America's Big Three Entitlement Bankruptcies Are Inevitable," and it's written by Stephen Anderson. This has to be good news. All right. America's federally sanctioned entitlement programs, including Medicare, Medicaid, and Social Security, are facing impending bankruptcy. These programs, designed to provide healthcare coverage and retirement benefits, are critical components of the federal budget, accounting for around 50% of the total budget at $2.7 trillion in 2023. Medicare, established in 1965, offers federal health insurance to individuals age 65 and older who have worked a minimum of 10 years. It covers around 80% of medical costs, but excludes dental and eye procedures. Medicaid, a joint federal and state initiative, provides health coverage to over 72.5 million Americans, primarily under the age of 65. Social Security, created in 1935, supplies retirement and disability income to qualified individuals and their families. It's predicted that by 2023, 67 million Americans will be receiving Social Security benefits. For now, probably not much longer. However, these programs are on the verge of insolvency. Medicare suffered losses due to waste, with the Government Accountability Office uncovering fake or bad addresses in the provider list, amounting to $60 billion lost in 2014. Medicare has been plagued by cost overruns and multiple reforms, resulting in inefficient price controls and reduced competition. If I could stop here, anything the government gets involved in usually makes it more expensive and more inefficient. So, if you want good health care, stay as far away from the government as possible. Medicare's Hospital Insurance Trust Fund, which finances Medicare Part A, is projected to be depleted by 2031, leaving a shortfall in reimbursement payments. Similarly, the Social Security Board of Trustees anticipates that the Old Age and Survivors Insurance Trust Fund will be depleted by 2033, causing beneficiaries to experience a 23% reduction in their monthly payments. Potential reforms to address these impending bankruptcies include allowing taxpayers under the age of 45 to opt out of future benefits. Well, I'm 49. Can I opt out too? I really do not want that. And I like my money back too. It's not like you get to keep it. Another option involves redirecting their tax payments into separate retiree healthcare and retirement accounts. Some advocates suggest raising the Social Security age to at least 75 or eliminating Social Security and Medicare altogether, relying on the free market for solutions. States and federal governments are seeking to reform Medicaid by targeting fraud. Yeah, well, the government is the fraud, and the people who work in government are the fraud. Are they going to throw themselves in jail? I doubt it. However, a one-size-fits-all reform may not be suitable due to the complexity of the programs and the diverse needs of the population. The reality of the situation calls for urgent action to address the impending bankruptcy of these entitlement programs, with potential consequences borne by the average citizen who rely on them. Here's my guess. The people in charge will do nothing. They'll wait till it collapses. Personally, I am praying and hoping that the central government, the state, falls apart. And you will never get everybody to agree to one centralized system ever again. So once it collapses, I think we'll be free and clear. Granted, we'll probably never get our money back, but to not lose 30 or 40% of what I make going forward, I'll live with it. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.